Hi everyone, this is Robert Eldridge with annuitycampus.com. Today I'm going to discuss equity indexed universal life insurance policy. It's the same as an indexed universal life insurance policy. There's just different terminologies. Basically what it is this. The cash value is tied to an index. So when the index goes up, you make money. On indexed universal life insurance policies, there's no downside risk. So if the index goes down that year, you don't see a negative on your statement. Your cash value will never go down, okay? And this is how it works. As each year the policy makes money, you get to keep those gains. So you have your original principal plus any money you put in. And on a down year, you might get a zero, but you still keep all your money. Again, the market went up, you get that. The market goes down 4 or 5 years, whatever, you get to keep your money plus that. If it goes up again, you get to keep that. So I say this in my videos, do you want the greens or the reds? The greens or the reds? Well, I want the greens. And that's what an indexed universal life insurance policy does, just like an indexed annuity. You keep your principal plus the gains, but you never have any downside risk. The only thing on this is your cap that what you can make. So if you're comfortable with 10% caps a year, this will work for you. If you want to make an unlimited amount, then you need to go into a variable product, but you will not lose money on this. And some of the benefits, again, there's no downside risk. The minimum guarantees every year are range between 1 and 3%. So even if the market does go down, you get a zero on your statement. But some of these will add 1 to 3% to your account value regardless. It's pretty neat. Tax-free growth, like a 401k IRA. It's an asset class. It builds cash value. You can access it. Living benefits, you can access that cash value before you're 59 and a half. So you won't get taxed on that money with a 10% IRS penalty early withdrawal like you would from an IRA or 401k, and it grows tax deferred. And more importantly, if you set this thing up right, you will not pay taxes on the money once you receive it. You see, with a 401k, one of the biggest problems is you build it for 20, 30, 40, 50 years, whatever it is, and then when you go to take the income, you're going to be taxed. It's going to be taxed as ordinary income, okay? Not on your own money, but as the interest that you put in over those years. So if you're getting a $1,000 a month payment, maybe 500 of that's going to be taxed or more. That's going to really eat into that. So you might be left with maybe $650. And that's not a whole lot. But with this, if you set up correctly, you could take this income stream, let's say the same $1,000 a month, but instead of being taxed, you're not. Pretty neat stuff. And by the way, for some of you that want to retire before you're 59 and a half, this works great as well. If you want to buy cars or houses, fund your own bank, which is your life insurance policy, and access it as you go along in your daily life. You don't have to wait till you're retired to use it. That's the best thing. Oh, and by the way, it has a death benefit. So anyway, if any questions, please give our office a call. We'd love to give you a consultation and see if this will work for you in your situation. Thanks again. Have a great day. Bye-bye.